Have you ever noticed something strange? Most people spend years trying to save money. They skip expensive dinners. They cut back on shopping. They work overtime. They move money into a savings account every month. And for a while, it feels like they're doing everything right. But then one day they look at their bank balance and realize something uncomfortable. The money is there, but it isn't really growing. Imagine spending 5 years building your savings account only to discover that inflation has been quietly eating away at the value of your money the entire time. You did everything society told you to do. You were responsible. You were disciplined. You avoided unnecessary risks. Yet somehow, you're still not getting ahead. And that's the moment many people begin asking a very important question. Is saving money enough? The answer surprises a lot of people. Because while saving money can protect your future, it usually doesn't create financial freedom. That's where investing enters the picture. Not as a replacement for saving, but as the next step. The step that turns money from something you work for into something that starts working for you. Today, we're going to break down exactly how ordinary people make the transition from saving to investing without taking reckless risks, without becoming stock market experts, and without feeling overwhelmed. And by the end of this video, you'll understand why this single shift in mindset has created more wealth than almost any financial trick you've ever heard. Let's begin. Most people think saving and investing are basically the same thing. They're not. In fact, they serve completely different purposes. Saving is about protection. Investing is about growth. Think about it this way. Imagine you own a car. You have insurance to protect it, but you wouldn't expect your insurance policy to make you rich. Its job is safety. That's exactly what savings are. Savings protect you from life's unexpected problems. Investments, on the other hand, are more like planting an orchard. You put something valuable into the ground today because you expect it to become much more valuable in the future. Both are important, but confusing one for the other can cost you years of financial progress. Here's a simple example. Let's say you have $10,000 sitting in a savings account, earning 1% interest. After 1 year, you'll have around $10,100. Now imagine that same $10,000 invested in a broad stock market index fund, earning an average annual return of 10%. After 1 year, it becomes roughly $11,000. At first glance, the difference doesn't seem life-changing. An extra few $100s, nothing dramatic. But that's because most people underestimate one of the most powerful forces in finance: time. The real difference isn't what happens after 1 year. It's what happens after 10, 20, or 30 years. Because every year your investment growth begins generating additional growth. Money starts earning money, and then that money starts earning even more money. This is the power of compounding. It's the closest thing the financial world has to a superpower. Let's say 2 people each start with the exact same amount of money. One saves, the other invests. 20 years later, the difference can be tens of thousands of dollars. 30 years later, it can be hundreds of thousands. And over an entire lifetime, it can completely transform someone's financial future. This is why the biggest financial divide often isn't between people who earn different incomes. It's between people who understand how money grows and people who don't. But if investing is so powerful, why do so many people avoid it? The answer has nothing to do with intelligence. It has everything to do with psychology. Human beings naturally crave certainty. We like things that feel safe. When money sits inside a savings account, it feels stable. You can open your banking app and see the exact number every day. No surprises, no sudden drops, no scary headlines. Investing feels different. The value moves. Some days it's higher, some days it's lower. And for beginners, those fluctuations can feel terrifying, even though they're completely normal. In fact, one of the biggest mistakes new investors make is assuming that temporary declines mean permanent losses. They don't. The stock market has experienced recessions, crashes, wars, inflation crises, and countless moments where people believed everything was falling apart. Yet over long periods, it has continued moving upward. Not in a straight line, but upward. And that's a lesson every investor eventually learns. Volatility is normal. Panic is optional. Now let's talk about how to make the transition from saving to investing the right way. Because contrary to what some people think, you should never invest every dollar you have. The smartest investors don't put all their money at risk. They create a foundation first. Step 1 is building an emergency fund. This is your financial safety net. Life is unpredictable. Cars break down, jobs disappear, unexpected expenses happen. That's not pessimism, that's reality. An emergency fund protects you from turning small problems into financial disasters. A good rule of thumb is to save enough cash to cover 3 to 6 months of essential living expenses. This money stays liquid, it stays accessible, and most importantly, it stays out of the stock market. Its purpose isn't growth, its purpose is protection. Once that foundation exists, something interesting happens. You stop viewing every market fluctuation as a threat because you know your immediate needs are already covered. And that changes everything. The second step is creating 2 separate mental buckets. This sounds simple, but it's incredibly powerful. Bucket number 1 is safety money. Bucket number 2 is growth money. Safety money is for stability. Growth money is for your future. The problem is that many people mix these 2 categories together. Then every time their investments fluctuate, they feel like their financial security is disappearing. But that's because they're looking at growth money through the lens of safety money. When you separate the 2, investing becomes far less stressful. You stop expecting short-term stability from long-term investments, and you stop expecting long-term growth from short-term savings. The third step is starting small. This is where many beginners get stuck. They believe investing only matters if they have thousands of dollars. That's simply not true. The amount matters less than the habit, because investing isn't a single decision, it's a repeated behavior. Someone who invests $100 every month for years will often outperform someone who keeps waiting for the perfect moment to invest a large amount. Consistency beats perfection, again and again. And this brings us to one of the most important lessons in personal finance. Time in the market is usually more important than timing the market. People spend years trying to predict what stocks will do next month. Meanwhile, successful long-term investors focus on what will likely happen over the next 20 years. That shift in perspective changes everything. The fourth step is keeping your investments simple. Modern finance has created thousands of products: individual stocks, options, leveraged funds, cryptocurrencies, complex strategies. And while some investors choose those paths, beginners often assume complexity equals higher returns. It doesn't. In many cases, simplicity wins. That's why low-cost index funds have become so popular among long-term investors. Instead of betting on a handful of companies, you're buying small pieces of hundreds of businesses at once. You gain diversification, you reduce risk, and you avoid the impossible task of constantly trying to predict which company will become the next big winner. Simple doesn't mean ineffective. Often, it means sustainable. And sustainability is what builds wealth. Now let's talk about the secret that makes investing truly powerful: automation. Imagine investing every month, whether the market is up or down, whether headlines are positive or negative, whether you feel confident or nervous. You simply continue investing, month after month, year after year. This strategy removes emotion from the process, and that's important because emotions are responsible for some of the worst financial decisions people make. People get excited when prices are high, they get scared when prices are low, and they often end up doing the exact opposite of what creates long-term success. Automation solves that problem. It turns investing into a system instead of a series of emotional decisions. Let's look at a simple scenario. Imagine investing $300 every month. Not $3,000, not $30,000, just $300. Over time, something remarkable happens. Your contributions grow, your returns grow, and eventually the growth generated by your investments becomes larger than the amount you're personally contributing. At that point, your money begins doing more work than you do. And that's when investing becomes truly exciting. Not because you're getting rich overnight, but because you're building momentum. Now here's a question many people ask. What happens if the market crashes right after I start investing? The answer might surprise you. For long-term investors, market declines are often opportunities. Think about it. If you're investing every month, lower prices mean your money buys more shares. You're essentially purchasing future growth at a discount. The problem is that most people focus on short-term fear instead of long-term opportunity. They see a falling market and think something is wrong. Experienced investors often see the same situation and think they're getting better value. The difference isn't information, it's perspective. And perspective comes from understanding the long game. The wealthiest investors aren't successful because they predicted every market move. They're successful because they stayed invested long enough for compounding to work. They understood that temporary setbacks are part of the journey, not the end of it. So if you're currently sitting on money in a savings account, wondering what to do next, remember this. You don't have to choose between saving and investing. You need both. Savings creates security, investing creates growth. Savings help you sleep at night, investing helps you build the future you want. One protects your money, the other expands its potential. And the people who achieve the strongest financial outcomes are usually the ones who learn how to balance both. Build your emergency fund, create your safety bucket, start investing small, keep it simple, stay consistent, and most importantly, give your money time. Because wealth is rarely built in dramatic moments. It's built through small decisions repeated over and over again. The day you stop seeing money as something you merely store and start seeing it as something that can grow is the day your financial journey changes forever. And that single shift may end up being one of the most valuable decisions you ever make.